Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Thank you all for spending time with us this weekend, and boy, oh boy, we had a busy week. A lot of company updates, a lot of market updates for a week that was kind of boring for the markets, but boring in a good way because everything continues to, or not everything, close to everything, continues to, in a way, melt up. Markets, the broad averages are doing well. Crypto's doing well. Commodities continue to do well. Really seems like the US dollar, that's been weak, and bonds, that's been boring. Other than that, I assume a lot of people are out there watching their portfolio, again, kind of melt higher. We'll cover that, all these different markets in the first half of the show, and in the back half of the show, going to focus a little more on the old school energy, oil and natural gas, two other markets that have been slow, kind of boring, but again, a lot of other opportunities out there. So without further ado, we're kicking off this show with Rick Bensignor, president of Bensignor Investment Strategies, writes the institutional newsletter, Supposedly Irrelevant Factors. That's read by some of the most successful hedge funds in the world. And on the retail, individual side, probably the side that most of you, our listeners, care about, check out the In the Know Trader website. I'll post a link in the show notes. Rick has two products, a weekly report called the Tactical Trader Report and a daily report called the Daily Tip Sheet. Rick, let's just start off. Big picture comments. It seems like there are a lot of bull markets out there. Arguably, a lot of bubbles out there forming as well. What's your takeaway from this environment where markets continue to melt up and it's not just one or two sectors that seem to be leading this melt up?
Well, sure, when we look at weighted stock indexes, they're on all-time highs. So you have SPYs and Qs, which obviously are the S&P 500 and the NASDAQ 100 at all-time highs. And generally, over the last couple of weeks, every week they're making new all-time highs. A couple of the 5 days are pushing to them each week, sometimes even more than that. So when we look from that perspective, the market's doing just fine. But if I were to ask you, let's say in the last 8 weeks, how many of the 11 sectors are actually performing and even doing better than the S&P, there's actually only two of them, 2 of 11, technology and industrials. And the other 9 are underperforming. So it's a very weighty, top-heavy kind of rally. Many did not see that coming off of the April low. And in one of the rare circumstances where the investing public outsmarted the institutional world, they were big buyers on the way up, whereas institutions were mostly selling into the rally. And many of them have missed the last, fair to say, probably 50% of the rally off of that April low. So you get a sense of not only where the public's interested, because it's been mostly large cap tech, mega cap tech that's pushed this higher. And then the industrial sector, which almost for always is essentially kind of a neutral weight type of sector because it is so diversified. Most of them kind of wash themselves out over the course of the year, and you really don't get much alpha out of industrials. This year, you really are getting some, and part of it is, I'll give you two examples of kind of sectors at the extreme. On the top end is something like aerospace and defense. A lot of people use ETFs to track that. One of the ones I look at frequently is XAR ticker. And that's been flying and historically way above its 50-week moving average to the point that it's deeply overbought here. So I can't recommend that now's the time and place that you first come into that. And then you've had something like, let's call it home builders, which only until recently has gotten a bounce and was on the worst side of that. And that's why industrials often end up just being kind of a sector that most PMs are generally in the equal weight neighborhood because they're really tough to materially underperform or materially outperform. This year is one of those rare times that that's happening. But it's only those two sectors, XLK tech and XLI industrials, that show continued kind of trendiness of outperformance with positive momentum. Everything else looks quite poor. What I did tell my institutional clients and actually retail clients also, now that I think about it, in the last 2 weeks is that I think the trough, the bottom has been put into healthcare in the sense of its massive underperformance and the trend of just how much downside momentum there's been. So I can't tell you that it's just going to start outperforming, but I think that some really beaten down healthcare sector names are probably worth looking at simply to get a sense of things that are really deeply oversold. And if you look at the 11 sectors, XLV healthcare is by far the absolute worst over the last several months and is finally just, picking up a little bit to be less bad. But it at least gives me a sense of potentially looking at some names in that space.
Okay, so maybe a opportunity in the healthcare space at some select names that coming off the bottom, maybe getting a little bit of a boost. And to the point you made about institution versus retail investors and how one of the few times where you've seen retail buy the dip and get it right in the weighted averages or in the big tech and institutions come running for the hills a couple months ago. We've been talking about this a lot on the show recently, Rick, that there does seem to be a slightly more informed retail investor base than maybe what you would have seen a decade ago because of the ease of information sharing. But there's also a little bit of frothiness under the surface in certain pockets. Like we've seen a return of the meme stocks in the last couple of weeks where a number of names of kind of beat up companies got a boost on the gamma options plays. And you saw it in Krispy Kreme and you saw it in American Eagle Outfitters. You saw it in Kohl's department. So some isolated names, but there's also things like Reddit having a big bounce, or when you look at Coinbase and the people in the crypto space, scorching higher. Look at Robinhood stock. We've mentioned that a couple of times, blasting to all-time highs. Is there just a preference for people to be in those high risk, high return plays over the safer names right now, over value stocks? And is that why we're seeing these weird pockets of concentration blasting higher where other spiders maybe not doing so well?
If you're a retail investor, the answer is probably no. If you're a retail trader, then the answer is to look selectively and find some of the stuff that's beaten down. And then I don't listen or watch or subscribe to or get any of these, what do you call them? Like, what's the word I'm thinking of? It's something board, BOARD, like these websites where they post to. And the meme stocks get a whole list of followers, whether it's through Reddit or some of these other places. If you're a trader, sure, you can look at most shorted stocks and then look to see how, when, or why there may be a reason that there could be a short squeeze. And if you want to play that, fine. Look at something like Kohl's earlier this week that was up huge, and the last couple of days it got destroyed. That's for traders, and you have to be good at technicals and you have to have discipline, but that's not for most people. That's, for traders who think they can outsmart others. The reality is very few get to be able to do that successfully over time. For your basic retail investor who's buy and hold, you kind of want to look more at quality names, and it could be quality names in beaten down sectors, but that's kind of where I think you generally want to put your time and effort into, and not be looking to, buy a stock that's heavily shorted and for the luck of maybe you'll catch a 10 to 20% move quickly. That's not for most people.
Rick, for I guess even the longer term investor, what about looking internationally? Because as well as, yes, the broad averages have done, I guess led by only a couple of sectors, international markets have actually performed even better than U.S. markets. Are we continuing to see this shift in capital flows?
Okay, so let me say something to what you just said. And that is that from basically the first of the year until the April low in the stock market, when the market was down, international did better. But since April 7th, the SPYs have done far better than international. So it's given back at least, I don't know, it's probably something in the neighborhoods of 40% of what international beat early on in the year is gone. Now, do I think you need to have non-US exposure? Yes. And I have, personally, I have FEZ, the ticker FEZ, which is kind of like the Dow Jones of Europe. That's the Eurostoxx 50, the best 50 names in Europe. I own ACWX, which is the MSCI All World Country Index X, or not including the US. So I do have international exposure, but the conversation about non-US doing much better than US this year is really from the beginning of the year into April, and now maybe where you're getting closer to a potential bounce point for Europe to start doing better. But I'm not convinced that for the long term, if you look out the next 5 years or 10 years, that you're going to do better outside of the US. It's pretty darn rare that over time the US underperforms. Oh yeah, there are pockets of time, but you can't beat US innovation, you can't beat US expenditures on that innovation. So I think most investors should be US dominant, but you should definitely have, I'd say, at least 10% of all your equity exposure in non-US. Where else do I have? I own EWJ, that's Japan. They got a nice boost this week because of the tariff deal. And that's actually something I recommended, I don't know, a month ago or something like that to my weekly tactical trader report clients was we bought EWJ. And it's doing very nicely. Better than the S&P.
Well, Rick, another sector that's been pretty hot is the metals space. Not so much oil and gas and the commodities, but when you look at gold, it's holding up there, but the gold stocks have done some catch up and even seen some things filtering down into the smaller junior stocks. But silver with a big catch up trade, the highest level it's been since 2011 and up to $39 now an ounce. And you've seen copper this week at an all-time high again, some of that on the back of the Trump noise around putting tariffs on copper, but copper had already popped its head above $5 twice. These are the highest levels copper's ever been. Platinum at the highest level it's been in 14 years. Palladium catching fire again. So really across the board in a lot of the metals, a lot of action, but in the related equities, a lot of life there too. Are you following at all some of these moves in the commodity space?
I certainly am. I got my start in the commodities industry, and part of what I write about every week for both retail and institution, I cover the commodity sector. I tend to focus on the metals and energy parts, and I'm not generally looking at the cattle and coffee markets, but I look at the most deep liquid ones, and that tends to be oil, natural gas, and across the metal space. So I am a big fan of metals. Gold topped in April. It's consolidating. If you were to pull up a chart of COMEX futures for gold, you have a perfect downtrend line from that April high that you draw to the June high, and then this week's high was right against that same downtrend. So kind of in a descending, you can actually, depending upon how you draw it, you actually have kind of a pennant formation, so a triangular formation. And I'm hoping to get kind of a washout towards the downside, not a huge one, but just something that gets us back towards something in the neighborhoods of under 3,200 to 3,100 in gold to reload on the upside. I still think over time it's heading higher. Silver right here, actually, I just sent one of the largest portfolio managers in the world who runs a metals fund a chart on silver, which like kind of right here, right now, I wouldn't be buying silver. It's up against some targets, and the four unrelated targets are all in this general area that SLV is trading right now. So I'm not going to buy it right here, right now, but I've been long. I got into silver a little too early in 2011 when it got up to, I don't remember if it was a $40 high Back then, I bought SLV and I think it was like 22 or $24 range. And I've held it now. Obviously, it's 14 years. Has not been a good long-term investment versus some other things. But finally, silver is, picked up nicely. I'm making decent money on it now. And I'm not really looking to sell it, but you could make the case to take some profits in it now as long as you're willing to give up some upside in order to replace it lower, or just wait for a pullback in order to buy some more down. But I do think metals have still decent room to go on the upside. I don't know if silver can take out the $50 high that it saw in 1980 when the Hunt brothers tried to corner the silver market. But I still, in general, like silver. But right here, right now, I think it's a tough buy, and you're likely have as trending as this is to the upside, you're as likely to have drawdown as you are profits if you first buy silver here and now.
Rick, again, for that long-term investor, and since you have been in the commodities sector for so long, we do hear from some commentators about a super cycle, or quite frankly, just how long cycles last in commodities. What's your assessment of clearly a bull market cycle, but time frame, duration of this cycle?
Well, look, if we use gold as a proxy for metals, it's been tagging along with the S&P for the last 20, 25 years. I think if you go back to the year 2000, you've done just as well in gold as you have in the spiders. And that's actually pretty darn remarkable if you think about it. So, precious metals, especially gold, has had a phenomenal run. I'd love to see it pull back as much as and I wrote this yesterday, clients, as much as we love to see our P&L continuously grow with minimal drawdowns. There are times that you actually want to see a draw, not necessarily a drawdown, but a pullback in where your profits are, whatever that number is, in order to have a chance to buy lower. I mean, think about it in terms of the S&P. Wouldn't you prefer a 5% pullback now to get in rather than trying to chase and buying all-time highs and knowing that at any given time you could fall 5+% simply because for no particular reason other than just how much this market's moved up in just a few months off of that April low? We don't love to see our when we look at our P&L and L and our brokerage accounts, we like seeing higher numbers consistently. But if you're a willing buyer in a pullback, gee, you kind of want to see that pullback instead of, do I want to buy the S&P up here or do I want to buy the S&P, several hundred points lower? So, to me, that's kind of how you want to think. So if you think long term, then the pullbacks are super opportunities to get long. Pull up a S&P chart for a 100-year chart. There's very few things in life you're ever going to find that look as good as that for a long-term chart that's investable. It starts on the lower left of your screen and ends on the upper right. Over time you want to be invested in stocks. So pullbacks are opportunities to get in. And sometimes those pullbacks have deeper pullbacks than you'd like to see. But if you're a long-term investor, even those horrific pullbacks that we saw from 2000 to 2003 or October 2007 to March 2009, moves that can knock 50 to 70% off of these indexes, they're ultimately all buying opportunities for the long haul.
Yeah, hard to beat the opportunities in general equities over the long term and over long periods of time. You're always going to benefit by buying those dips. You mentioned looking forward to potentially seeing a pullback in gold for reloading and taking some more positions. I'm curious what you do with something like copper, though, where it's at all-time highs right now. Some of that based on the potential tariffs on copper, but it was already blasting above $5 twice, once last year, once earlier this year. This is the third time a charm here. And I've noticed on the copper producers in the ETF COPX, they're not getting to the same high levels that they were when copper first breached $5 last year. So maybe just your thoughts on copper itself as a economic bellwether, but also the copper stocks and how they're not really following the metal to the same degree they were.
No, they're not. If you look at like one of the biggest names like FCX, Freeport Mac, it's a little disappointing to see where it is relative to where it's been. Right now, even with the up move in copper, you still have the chance for it's early yet to make that call, but you're still in the neighborhoods of what the spike high was in early July on the day that Trump announced the what was it, 10%, 25% copper tariff, 50%? I can't even keep track
50,
anymore.
50. So
Percent, right, tariff. So that was the first week of July, and we're kind of yesterday and today, those are where the highs are. Now, it's no surprise if it pushes past. The breakout looks real. Unless you're an experienced futures player, I wouldn't be using futures as, the way you play this. But here, I'll tell you, from the 2022 low in copper, which was down at $3.20 or so, the target off of that move is, hold on, I'll get you a precise level for the futures. It's 609. So, you're kind of the eighth inning of that rally to what the target is. And it doesn't mean it can't go higher. And the breakout looks real, so you want to be buying pullbacks. Looking at copper as a indicative type market for the health of the economy, that's all good. So it all spells to buy pullbacks, buy a little now if you have zero exposure, but save 75% of the money that you are going to invest for pullbacks. And in commodities, yeah, they generally come. They generally come.
Rick, let's look at gold stocks too, because as much as people were saying maybe last year, especially early on last year, how gold stocks were lagging the strong gold price, now that gold has moved sideways in a way, maybe consolidated over the last 3+ months. Gold stocks have continued to do pretty well, and we've even noticed a lot of money filtering down into the smaller stocks. Almost seems like an even more bullish or risk-on environment for the gold stocks. Take us through what you see, either gold stocks broadly, as in GDX or GDXJ, or any leadership you've seen in any in particular names.
Well, all right. So GDX is what I use as my benchmark for the whole sector. It's made the highest highs this month and last month for the move. You're back to virtually the highest high made in 2012. The all-time high is in 2011. And that's just about 60, what is that, $67 or so in GDX. It's currently at 53 and change. So it still has room to go to challenge those all-time highs. But I think more importantly is, and I was just writing about this as part of my weekly report that goes across lots of sectors. If you get a pullback to the mid 40s, let's call it, a 10% pullback. May not get it, but that's kind of where the good support is now. And that's where the high from 2020 was that we just took out also. So I think if you get a chance and you get to buy GDX in the upper 40s, you do it. I think down the road you'll be rewarded. And I do think it's going to take time, but I do think ultimately there's a very decent chance that GDX makes a new all-time high and takes out that 2011 high. A lot of stuff has to happen for that to occur. But looking at how this, is formulated and where it broke down from, first you got to get through kind of right above where we are now at 56-ish. And then if you can build a base above 56, you test 63 and a half to 67. And then if you get above there, you get new all-time highs and, it's a whole nother leg.
Just a quick follow-up on that, Rick, because you've been following the sector for so long. It's surprising to me, and I think a lot of other people, that we're not already at all-time highs in the GDX, considering that high from 2011. I remember that vividly. That was when gold went all the way up to 1923. Now we're at 3,300, 3,400, and the margins back then, I think, were 650 an ounce for the average producer. Now the margins are $1,200, $1,500 for producers. So the fattest margins ever, and the biggest percentage of margins and revenues ever, the highest gold price ever, and we haven't even made a new high. what do you make of that as far as following these indexes versus the underlying commodities and the discrepancy there?
If I had to guess what it is, because I don't know, but if I had to guess what it is, it's that for so long the sector has been a underperformer that it just doesn't have the interest that other ones did. If you're a portfolio manager, let's say you're a global macro portfolio manager and you can put your money wherever you want to, you would have done much better being in technology stocks than thinking about gold stocks for the last 15 years. It's just not a sector that's done anything appreciable. I'm not saying it hasn't, doubled or tripled in price, but if you compare that to, you know, think back to, let me think what year it was. I think it was 2009, the great financial crisis. The S&P bottomed at 666. Look at where it is now. I mean, it's 10 times the price. So it's just that the sector is unloved by the street, which probably means there's opportunity here down the road. And it's probably a sector to be involved in because if it starts moving higher, it has a chance to really pick up some steam. But I think that's probably why it's just not even near, on percentage basis, it still has such a decent amount to go to hit that all-time high at 67.
Okay. Well, targets to watch for, and maybe we do see that shift and outperformance. It takes a little time for people to warm back up to sectors. What about old school energy? Oil, natural gas. Oil continues to be stuck in a lower trading range now after recently breaking down. Natural gas has been coming off a little bit. What's your outlook for either of these sectors?
So there are two major parts of the market that we look at when you look across the asset classes. There are two major places that I continuously tell both institutional investors and retail clients to stay away from, and that is oil and the U.S. bond market. The 10-year has a pretty flat 50-week moving average. People in the industry are more confused than ever. Bond portfolio managers. You're not getting the clue out of the bond market as to the clues you normally get to help other markets, which include the U.S. equity market, the U.S. dollar, and to some extent commodities. So the bond market, I kind of want nothing to do with, and the crude oil market, I want nothing to do with. I think it was a week ago, maybe 2 weeks ago at most. I looked at the CFTC Commitment of Traders report. 85% of all open contracts were held by what's considered smart money, producers, processors, people in the industry. The speculators have pretty much walked away from oil as they should. It has done nothing appreciable in a few years. And so what was it back in 2022 when the Ukraine war, against Russia started and oil spiked to $130 a barrel. It sold down from there to 65-ish and then went to 95 and then back. And now that, this year we made new lower lows. Percentage wise, there's stuff there, but day in, day out, if you think you're going to outsmart the oil market and you're not in the oil market, I'm gonna tell you, chances are you're gonna get your rear end handed to you trying to trade oil. And when 85% of all open interest is by people in the industry, you don't want to play that market. You have absolutely no edge. So I'm just telling people there's nothing to do at $65 oil. And there's nothing to do at $75 oil, and there's nothing to do at $55 oil. And that's the range this year. So there's nothing to do in oil. Nat gas, different story. It's been selling off recently, broke the uptrend line from the low. So that's just a little bit more interesting in the sense of will it or can it make new lows? For people who are long the ETF like UNG, it's a horrible, horrible long-term investment. And the energy space in general has been, if you look at XLE divided by, let's say, the spiders, I think even as of last week, it just made a new secular low. So it peaked in October of 22, I think it was, and it's pretty much been steadily declining versus the S&P since then. So it's just and if you look back 20 years or 25 years to when these spider sector ETFs started trading in the year 2000, there's no sector other than energy that in the last 25 years you've actually not made a penny in being in. I mean, think about it. You've not made a penny in energy. So it's just not a sector that really interests me. And personally, I own Chevron, and I think that may be the only name I own in the entire space.
Well, Rick, on the energy tip, but maybe a different commodity, what are your thoughts on uranium, which has had a lot of attention this year from the Trump executive orders? He did 4 executive orders on nuclear. When you look at an ETF like URA, it's up at, it's not at all-time highs because that happened back in 2011 as well, pre-Fukushima, but it's at 52-week highs, and it's definitely on a good uptrend the last few years. How do you look at something like uranium and the uranium equities?
So it's had a huge move since the April low. That ETF was trading $20 on the April low, and now it's 42. And so it's more than a double. The target from the 2022 low, which was the secular low for the stock market, is not even a dollar higher from where it's trading. So do I want to buy it here and now? No. Do I think it gets back under 33 where it broke out from? Probably not. But if I have a choice of buying something at 42, I mean, right now, where would I put first support? About $37. That's the earliest I would consider buying.
Interesting. Rick, let's also move over to the crypto space because cryptos have done pretty well as well. A lot of, I guess, regulatory support, or the government sure talking a lot about crypto, and crypto stock being added to the S&P, more crypto IPOs coming out. There's a lot going on in the crypto space. What has your eye? What are any targets you have for Bitcoin?
So Bitcoin, I had a target at 118 and change. The next target is 122.5, and above that 125, let's call it 126, and above there 131 or so. This is for Bitcoin futures. And so that, and I use that as the proxy. The thing is with something like Bitcoin, you know you could buy it and have a 30% drawdown. It's just the nature of the beast in this particular market. But it had a double top near 110,000 that lasted for 6 months before it broke out a couple months ago. So I'd say anywhere from 110 to probably, I don't know, 105 or so now should be support. And I was asking a friend of mine who has been so correct about crypto. It took me a long time to, get involved myself. And it's still been as a percent of my total assets, it's a small piece. As a percent of his assets, it's a very large piece. So I asked him a few questions this week. One is, I said, by chance, what's your average price in Bitcoin? And he says it's about $8,000. So he's made a killing because he was an early adapter. I asked him, if you were going to put money in crypto now, where would you put it? Because there's talk that Ripple could have this and Ethereum's playing catch up. He said, it's a no-brainer. I'm thinking, well, I don't have a brain. Like I don't know which one. And his answer was Bitcoin because of the limited supply. And as high as this thing is priced, he claims, and he's clearly, a Kool-Aid drinker of it, but he's also been completely right. He thinks in the scheme of things, it still is only in the first inning of where it's going. Now, that to me is pretty hard to fathom, given that, you could have bought this at $20,000. I think when futures started trading a few years back, it was at $18,000. Right? So it's already 6 times that price a few years. He thinks, you can play some other coins, but he still thinks Bitcoin has a huge move coming. because there's only so much Bitcoin that can forever be, what do they call it, mined. And therefore, the value of it has to go up over time as long as there's increased demand. And based on everything we know, and the more, including the government, getting involved and other places in the world doing so, he thinks, that's where you put your money. And you live with some of the crazy moves along the way, but you have to be committed to it, and you have to be willing to have, multi-double digit percentage moves potentially against you in order for the bigger picture. So it's clearly a very speculative idea. But think back to a year or two ago when Jamie Dimon would say, it's a joke, we're not doing it, da 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 da, and now, JP Morgan's all over it. The more and more it gets accepted, the more demand it creates for an instrument that has limited supply.
Crazy to think it could be early innings because boy, oh boy, what a run it's been on. But hey, the ETFs are new and the adopters, the big institutions, they are starting to adopt it even more. And I guess globally, it's still kind of a small market, but just crazy to think about that. But hey, either way, Rick, great chatting with you. Thank you very much for sharing your insights on, again, a wide range of markets. And for everyone that wants to follow along with Rick, for all you active traders out there, and even traders that want to take longer term positions, visit the In the Know Trader website. Visit our website within your podcast player or our YouTube channel for that direct link. Rick, very much enjoy our conversation. Thank you so much for taking time to share your thoughts. And everyone, stick around. We're going to be right back.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And now time to switch over to the energy sector. It's a sector that unfortunately has kind of lagged the rest of the commodity markets as money's flown into commodities, but it's been more on the metal side of things, not so much on the energy side of things, or at least old school energy being oil and natural gas. Because we're talking oil and natural gas, we're chatting with Dan Steffens, president of the Energy Prospectus Group. Now, Dan, let's just face this right on here. Oil has been trading in a very tight range for almost the last month, between $65 and about $69 on the crude price. And quite frankly, this is within, I guess, a trading range, but at the lower part of a trading range that it's been in for a couple years. What's your takeaway, Dan, from this relatively boring oil market?
Well, you may recall that when the tariff war started in March or whatever, whenever you announced that, they were talking about oil, going down to $40 or something. So we at least got past that noise because it really hasn't created much inflation. And it looks like they're going to be making some kind of deal with most countries eventually. I mean, I do wish they'd put some kind of true deadline on this so that they can get going. But the big one's going to be China, whatever they can agree to with China, but it looks like they're going to meet again next week. And I think they're moving towards something that's going to be reasonable, I guess. But anyway, so it's really just the fear of the trade war, because actually the oil market itself, the physical market, when you look out there, is really tight. I was just looking at a report, today's Wednesday, in the EIA report. U.S. crude oil inventories are 9% below normal. And I look at it's normal for where they should be based on the 5-year average. And it's actually outside of the bottom of the range. It's not even within the range. It's never been this low this time of year, because actually this is the driving season. This is when we drain our crude oil inventories to produce gasoline and diesel, so summer blend transportation fuels. So in the physical market, you look out there and we should be in the 70s. And I think it's just this fear of the trading range, which fear of the tariff war is really a fear of recession. And if we would have a global recession, a true global recession, yes, you might see demand for oil-based products go down. But the numbers sure don't point to that happening.
Well, Dan, when you think about the oil market, I don't think we can extricate the OPEC situation, but also demand. I've seen a number of articles out saying that demand just wasn't as robust, not just in the US, but even in Europe this year as normal. So even though we're in the middle of summer driving season, it doesn't seem like the demand has been as much. So even if storage levels are down, if there's not that pull to market from demand, doesn't that still keep the prices muted?
Yeah, and it's a mixed market because see in gasoline now we are never going to be in any pressure on gasoline from like running out because these shale plays produce really light oil that is perfect for making gasoline. And we actually have to export some of our light oil because we don't have enough refining capacity to handle it. Our problem in the US is we need more black oil. We need Canadian oil and we need Venezuelan oil and whatever, so that we can make diesel. And the country runs on diesel with all these big construction projects are announcing, AI data centers and new manufacturing facilities moving here. They don't make those with things that run on electricity or run on gasoline. They make them on machines that run on diesel. So the diesel inventory as of, last week, the week ending, what was it, July 18th, the diesel inventory in the US is 19% below normal, outside the bottom of the range. I literally have never seen it this low for this time of year because, diesel inventory, like gasoline inventory, really picks up in the middle of the summer. So that from that fundamental standpoint, it looks really tight in the US. There's definitely no glut. And you look back to the pandemic, when the pandemic really shut down, demand for oil-based products in early 2020, that immediately pushed inventories like to the max levels, and producers just had to shut in wells because there wasn't any storage capacity left over. But we certainly don't have that situation now. And then I was looking at a report this morning, and they don't even mention the Middle East anymore, the war over there. And then you start reading the highlights, the news articles and stuff, and there was a Iranian helicopter went by a Navy ship, and they're shooting off missiles again. They're talking about not ending their uranium enrichment programs. So that war is not over. That war is not over. I mean, Team Trump is focused on the tariff wars right now, but I think Israel's not going to allow them to start enriching that uranium again. So anything can happen over there, and Iran is really isolated now from the rest of the world. So.
It is interesting to see how these ongoing wars don't seem to impact the oil price right now. But if we're going to look at those inventory levels, which you say are low or at least below the 5-year average, we do also have to look at U.S. production, which is remaining very strong, even with fewer rigs turning. Is that why low inventory levels aren't having an impact because the U.S. is producing so much?
Well, pretty soon you're going to start hearing the U.S. oil production is peaked and it's going on decline. There's no doubt about it. We aren't completing enough new wells. You can't just shut down the drilling rigs and expect production to remain flat. So I think by the end of the year, U.S. oil production is going to be about 500,000 barrels a day, less than what it was in June. Over the last 6 months of the year, you're going to see a steady decline. We're just not completing enough wells. I mean, even some of the companies that I follow that are running rigs, they're because they have drilling contracts, they are completing the wells as far as running casing, but they're not perforating the wells and they're not hooking them up to, sales yet because they just, they don't want to sell these wells come on really at high rates and they don't want to sell that production into a low price market. So they go, and we do have some of the rigs are moving over to the gas plays. I've heard there's a pickup in the number of gas rigs drilling in the Haynesville to get these higher prices. But in the futures market, you guys ready to switch over to natural gas? Because the natural gas market, I think we got a lot of paper traders out here, speculators that are getting stuck with long contracts and they're having to close at the end of the month. So.
Yeah, Dan, let's switch to nat gas. I mean, it seems like between the two, between oil and nat gas, that nat gas actually has more potential excitement built into the latter part of this year as we move into the winter months. So what's your outlook on the gassers?
Yeah, if you think oil price volatility is high, pull up a 1-year chart of natural gas. It's like all over the place. We've been way up into the mid fours, and then we're down to like $3 again. But whenever you see these big moves in the futures market, what you're seeing is speculative traders. I call them paper traders. They cannot take delivery of the gas. So if they're long, if they don't close their contracts, they're going to get charged storage fees because they have to take delivery of the gas. And the guys that can supply the gas to fill that contract, they're going to stick it in a storage location someplace, and these guys are going to start getting storage fees. And I've seen that happen. When I was in public accounting, some guys went long and they forgot to close their contracts. The next thing you know, they're getting invoices for big storage fees. So that's what causes at the end of the month, you get a lot of that where they have to cover their positions. They get a lot of these futures contracts are traded on margin anyway. And, they're getting margin calls and they got to cover them.
What about stockpiles or inventories for natural gas? I've read some things that they are slightly above the seasonal norm right now.
Yeah, but they're above, when you look at the 5-year average, because they always go back to we're, 5 or 6% above the 5-year average for this time of year. But that's looking backward. I mean, the North American gas market, and this is going to be true in Canada as well, it is much bigger. There's much more demand for U.S. natural gas than there was 5 years ago. So that's a misleading thing. I say you need to compare it to where we were last year. We started the winter last year with gas and storage way above the 5-year average. And by the end of the winter, we had drained it below the 5-year average. So it's just a much bigger market. And, you look at like these LNG export facilities, we had zero LNG export capacity back in 2015. And here we are with like 15, 16 BCF a day of export capacity. You got 3 big LNG export facilities that have just recently come online, one being LNG Canada. And that's demand. That's real demand. So between now and 2030, demand for U.S. gas, just U.S., not Canada, is going to go up by 5 or 6 BCF per day per year for at least the next 5 or 6 years. And there's other ones that are getting approval now to be built, beyond 2030. So it's just going to keep going up, up, up. And we lack the infrastructure. We've got massive gas reserve. North America has got almost unlimited natural gas reserves, depending on price. I mean, you just keep going deeper and you're going to find more gas. But you can't build these big, long pipelines. You can't build pipelines from the Gulf Coast to the middle of the Permian Basin, 700-800 miles. That doesn't happen overnight. So you got to do that. And then you got to have, processing facilities, compression and everything have to be in place before you can put those wells online. So it's much tighter than just looking at where we are in the 5-year average. And plus, it has been mild. Like I live in the Houston area, and June and the first half of July has been relatively mild weather. I mean, we've had a ton of rain. I mean, you heard about the floods in the middle of Texas that killed all those people. Well, we've had a lot of rain in the Houston area. We don't get the flooding because it's flat and just spreads out. And it's been cooler, but now it's back near 100 again, and with 108, on the heat index, 108, 110 or something every day. So my air conditioning is running full speed constantly. So we're going to get some better, more bullish looking storage reports here in August that I think will straighten this out. But I don't see gas being below 3. If it dips that low, that's just paper traders covering their positions. But I think, we could go back to 4. I mean, just again, bring the year-to-date chart. You'll see how the volatility has been all over the place.
Well, Dan, you've also maintained in previous episodes that you thought by the end of the year, when we get towards the winter months, that gas could be pushing north of 4. And next year, a lot of the other analysts have, like a 450, 460 range for gas. What does that mean for the gas companies from an investment angle? People listening in, they want to know how they can capture some of these moves. So do you think that's still reasonable to see those higher prices by year end and next year? And what does that mean for opportunities in the nat gas stocks?
Yeah, like Range reported their second quarter results on Tuesday, the 22nd, and I just finished updating my forecast model for it. And they layered on a bunch of hedges at over $4 through 2027. And I think these gas companies will be smart to, whenever there is a spike in the gas price, lay on more, swaps and lock in those prices. So, and that's the thing from an investor standpoint. What you should do is make, not only look at the production mix. All upstream companies produce a mixture of crude oil, natural gas, and natural gas liquids. And those markets are very, very different. And, these guys, if they can lock in that price, then they're really good. But boy, I tell you, beyond 2025, yeah, we're going to have enough gas. We're going to have enough gas and storage to make it through the 25-26 winter. But it's the back half of 26 when I think it's going to really get tight, because you got even more LNG export facilities coming online. Golden Pass, Plaquemines is running up. I got another 2 BCF a day higher. Golden Pass is a big 2 BCF a day facility, and LNG Canada is just phase one is about 2 BCF a day, and they're already pushing forward to double capacity up there to 4 BCF a day. So beyond 2025, it's starting to really, really look like it's going to be very difficult for supply to keep up with demand from all these LNG export facilities.
So, Dan, on the stock front, whether we look at XLE, the larger energy sector ETF, or individually some of the larger energy stocks, especially oil stocks, even something like Exxon Mobil, these stocks are still doing okay. They're not really following the chart of the oil price. So, what's your assessment overall of, I guess, let's start with the large producers in the oil space?
Yeah, our Sweet 16 is really large cap, mid cap oil and gas companies that are. I just over the weekend and the last couple of days, I've been going over my forecast models line by line, every one of them, comparing them to First Class and other analyst forecasts. They're all going to report. The oil price went down, everything went down in the second quarter, and they're all going to report positive earnings. They're going to report strong cash flow. Most of every one of our Sweet 16 companies, based on my forecast, are going to be free cash flow positive in the second quarter, and that's going to be the worst quarter of the year. So they're looking really good for the second half, and they're very disciplined on their spending. They can, most of their really good acreage is held by production now, so they can, drop a rig or two and live within cash flow if they have to for a while. But they're still, they're not making as much money as when we had $80, $90 oil, but at $65 oil, they're making a lot of money. I looked at like range on an MCF basis. Their all in cash costs are only like 30, 40 cents per MCFE. And then they're selling the gas for $4. So their profit margins are still really, really strong. And that goes for the oil producers too. The typical upstream oil company, I would say, has got cash operating expenses, including back office, G&A, operating expenses in the field, production taxes, in the $12 to $15 per barrel range. So they're still very, very profitable. And as long as they got solid production, they're very, very cash flow. And they had a good year last year. The balance sheets are in much better shape. There's very few of the companies that have any near-term debt issues they can't deal with. So they're cut off from the capital market, and they're pretty much cut off from the debt market. So they know they're kind of on their own, and so they're being real frugal on how they spend their money.
Yeah, Dan, overall, the sector is much more prudent than it was, let's say, a decade or two ago. But you did bring up an opportunity that you see up in Canada with a company you want to feature, Whitecap Resources. It's traded on the TSX under the ticker WCP, and they've got a nice mix of oil and nat gas, and they have some fluids in their natural gas liquids as well. So kind of a nice mix of different exposure to the space. What trips your trigger about Whitecap Resources?
Well, I really wasn't covering it, but when they announced the merger with Varen, VRN, which is another Canadian company, that was one of my top picks in our Sweet 16. And that merger was announced in the first quarter, and they closed it on May the 12th. Yeah, May the 12th. So when they report their second quarter results, we're going to get our first real look at the combined, production and net income cash flow for the combined company. But it really, really looks strong. I mean, today's production is about 360,000 BOE per day. That's barrels of oil equivalent, 52.2% oil, 10.4% NGLs, and 37.4% natural gas. And that's another thing. I like to see companies that have this good mix of production. So maybe the oil price will be a little bit down, but the gas price is way up year over year. I mean, the gas prices are up like 40 or 50% year over year. And the outlook for the fourth quarter for gas especially looks really good. And so there's one. And what I liked about it too is because I personally like to put my money in companies that pay big dividends. It pays monthly dividends. The yield based on the current price was just slightly over $10 Canadian, is 7.2%. My price target is, my valuation today is $13 Canadian per share, which is very close to First Call's price target is 12.83 Canadian. And I sent out a report on it to all of our members, and I said, hey, buy it now for the yield before the market really figures this thing out. But the long range, because of its tremendous growth potential, they're like now one of the fourth or fifth biggest producers in Canada, and they're going to end the year with over probably about 375,000 BOE per day production. That's a decent sized company. And they've got a lot of running room in two or three of Canada's best oil and gas plays.
So, Dan, is this a play where you would buy before we get the earnings report, or is it something that you would think we should wait for the earnings report, see the market reaction, make sure things are going as planned, and then move into that stock?
Yeah, I mean, you could go that route, but let me make sure. Okay. I mean, it's up today, really. I mean, here, yesterday's at 10:14 on Wednesday, and I think it's going to get a lot of coverage. For one thing, just the size of the company is going to, force more of the analysts to start covering it. And I think they're going to really like the numbers that they see, and they give real good guidance, a lot of detail. So it's easy. It was easy for me because I already knew what Varen was going to do. It's easy for me to create a pro forma forecast model for it, and which comes very much in line with what the current tip ranks and first call have. So I feel good about the numbers, and it's going to be very cash flow positive. It's going to generate close to 2.5 billion Canadian in operating cash flow. This is not a small company, and your listeners may not have heard about it, but this is a very large company that's got a lot of potential for us, I think.
Well, Dan, just another kind of follow-up on this is we've talked about a number of M&A deals over the last couple of years with you, and it seems like in the oil space in particular, there's this period of time where when two companies merge, it's more noticeable when it's a private company and a public merging, but even two public companies merging like this with Varen and Whitecap, there's like this period of time where the market doesn't quite know what it's going to look like pro forma, and then maybe a quarter or two later, the proof's in the pudding, and then all of a sudden there's a big jump in the stock. Maybe just highlight your strategy there about sticking with the pro forma company because of this period of like uncertainty, and then the realization a couple quarters later.
Yeah, and I think what the number one thing that I do for our members is I think we give them good conservative, pro forma forecast models. And yeah, if you know what a company's going to look like when they have their first full quarter after an acquisition, that's going to help you beat the market because you got data that's, a lot of the analysts are too lazy to figure out, for one thing, and a lot of investors that don't because they do like you said, they don't really know. Okay, what's G&A going to do? What are the expenses going to do because of this merger? And most of the time, especially when you have two mergers of companies like Whitecap and Varen, because of the size of their companies, and the other thing is the synergy of the exploration people, like the engineers, geologists, and stuff. A lot of times, that's a big plus that's overlooked when you put those teams together. You end up with, two heads are better than one, or I guess, of how to look at the wells and the drilling completion methods and stuff like that. And I think that's where you see a big benefit of the synergies when you get into the next year. 2026 on this looks really good. My 2026 forecast is 3.3 billion in operating cash flow, and it looks good. And and I think the Canadian dollar firming up against the U.S. dollar is another reason why we like some of our Canadian companies better than the U.S. companies at this point. And they were overlooked. I mean, they were really trading at low multiples, until just recently. Anyway.
So, Dan, as we look maybe to some other stocks, what do you think the market cares more about? Is it growth or is it sustainable production at preferably lower quartile costs?
Yeah, I think, investors get into this their first time. They should be looking at, okay, what does the balance sheet look like? Do they have any debt problems? And I've got a couple of my small caps that, yeah, they do. Since they don't have access to the capital markets and they can't raise any more equity, they're just stuck. They got to pay down their debt. So all their free cash flow is going to debt payments, and that's not very attractive to investors. But leverage does work both ways. That's another thing. And if you do get oil, like it spikes up to 80, where I think is kind of the right price, actually, these things now look really, really attractive because they're generating a lot more free cash flow and they can start paying dividends. And actually, the biggest gains I've ever made personally is on little Canadian companies. Hemisphere is one of them, where I can see that in a year or two, they're going to be able to start paying dividends. And from talking to CEOs and stuff, I can tell that's their plan. They want to start paying dividends. So if you can get into these small caps, and I think I got into Hemisphere at under 20 cents, and now it's like $1.20 or something. And then when they start paying dividends, then you get a whole new layer of investors that will only invest in companies that pay dividends. And that's where I've gotten some of my biggest capital gains is on those small cap companies.
Dan, do you ever play the small cap or some of the growth ones with the idea that they're takeover targets?
Yes, I definitely do. And, that's what I used to do for Hess. We were out looking at public companies for takeover targets. And my team, we closed 3 really big deals and a bunch of small deals that we're up to like 3.5 billion in acquisitions, which in today's dollars would be like 8 billion. But yeah, if you can find some of these companies, perfect example of that was Earthstone. Earthstone, I knew the management team. These guys were building that company through acquisitions. And, one day they announced a takeover by Permian Resources, took them over. And I love Permian Resources. It's going to be a real strong company. It's like number 1 in the Delaware Basin, which is the western half of the Permian Basin. And when you combine those companies' assets and they jump to like 350,000, which is very similar to this Varen Whitecap thing. Now you've moved to a different level. And the bigger companies, size matters in this business. And when the bigger companies, they just instantly deserve higher trading multiples. Like you got some of these smaller companies like Hemisphere, they're basically trading at what their proved developed producing reserves as if they're not going to have any future production growth at all. But because the sustainability, if you look at Whitecap and you see what's their long range business plan and they lay it out, do they have the cash flow? Do they have access to capital to make that happen? And they also, because of their size and the strength of their balance sheet, they do have access to capital if they can come up with a good takeover target. They have no problem funding those deals. And that's how the great growth stories of the U.S., which is one is Diamondback Energy, classic example. They started doing that, got into a good period of time, were able to just start building through these acquisitions, bang, 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 increasing their production by 50, 60% year after year after year. And then suddenly the Wall Street gang just loves them. And, they're trading at a high multiple. So, yeah, the M&A market starts to really pick up, and it probably will. It also picks up as you head into year end. Usually you see some deals that are made so they can get them closed before the end of the year.
All right. Well, Dan, you gave us a lot to think about and look at within the energy sector. And hey, sometimes when markets are boring, it's the best time to take some position, especially when we do see this environment of commodities and resources continuing to do very well. That money very easily can rotate into some of the lagging sectors. It just comes down to time-wise. But again, slow markets can be a good time to position yourself. I just find it interesting that some of the big boys in the oil space, they're still doing quite well, even in this generally lower price oil and natural gas environment.
And I'd just like to say, if any of your listeners want to see our recent report on Whitecap, it's about a 15-page report, just have them send me an email, energyprospectus@gmail.com, and I'll be happy to share that report with them.
There you go. I'll even post your email address within the show notes on our website, podcast, and YouTube channel. Dan, thanks for your time on this weekend show. Everyone, thanks for tuning in this weekend. Thanks for spending some time with us. Hope you all found this weekend show valuable, and please go back through the week through our website, podcast, Substack, and YouTube page to listen to all the daily editorials and company updates from this last week. There were a lot of them because there's, quite frankly, just a lot going on in the resource sector. It's a bull market, so now's the time to really gear up and hopefully take advantage of it. Everyone, thanks for tuning in on this weekend show. Hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.